Learn to Earn by Peter Lynch and John Rothchild is a treasure trove for those just stepping into the investment world. Many people see the investment landscape as a daunting maze filled with complex jargon. However, Lynch and Rothchild use simple language and clear explanations to make it accessible to everyone. Lynch, drawing from his experience as the former manager of the Magellan Fund, opens the doors of the investment world to all readers, emphasizing that stock investment should be within everyone's reach, not just professionals. Before you dive into investing, it's crucial to take a step back and look at the history of America's capital markets. Understanding how the economy and finance have evolved gives you a significant edge in interpreting current market conditions. The lessons from history can guide our future investments. For instance, the market's development before and after the Great Depression of 1929 can shed light on the growth trajectories of young economies like Turkey. Lynch also highlights the importance of starting to invest at an early age. He underscores how small savings can grow into substantial sums over the long term, illustrating with concrete examples how a modest start today can lead to significant wealth in the future. The concept of a company is essentially a structure formed by a group of people coming together. Originating from Latin, the term means companion or partner. Companies form a separate entity known as a legal personality, which provides a significant advantage in the business world. For instance, during the Exxon Valdez disaster, the company's legal status protected shareholders from being sued individually. Without this protection, nobody would want to buy shares. There are key differences between private and public companies. Private companies are owned by an individual or a small group and typically do not sell shares. In contrast, public companies sell shares on the stock market, allowing anyone to become a shareholder. Brands like McDonald's or Coca-Cola are examples of public companies. These structures create equal opportunities for investors and contribute to the democratization of the economy. This way, anyone can be part of the success of these big brands they encounter in daily life and invest in their achievements. Investing in stocks is one of the most effective ways to contribute to a country's economy while building personal wealth. By purchasing shares in public companies, people support these companies' growth while securing their financial future. Companies use the capital raised from selling shares to open new stores, increase production, and create more job opportunities. This cycle boosts the general welfare of society because higher profits lead to more taxes, which fund public projects like schools and roads. Looking at the history of the investment world, the birth of capitalism happened as people started producing goods and services. Initially, the concept of money wasn't widespread, and most people worked for landowners. However, with the rise of international trade and the establishment of stock exchanges, people found the chance to earn money and improve their lives. Particularly in the 1600s, the Dutch made a significant leap by establishing the world's first public stock exchange. These developments laid the groundwork for the establishment of colonies and America's economic success. Investors became key players in economic growth and individual prosperity during this process. The story of the Plymouth colony and its investors reveals the challenges of entrepreneurship and financial disputes. While immigrants were striving to build a life in the New World, investors were concerned about how to recover debts owed to Pierce and Weston. However, the Plymouth colony was struggling financially, and the investors weren't seeing the returns they expected. Eventually, in 1627, they had to transfer their partnership to the immigrants for 1,800 English pounds, but the immigrants couldn't pay this sum immediately. Thus, they had to pay off the debt in annual installments. Under Governor William Bradford's leadership, a system based on private ownership was adopted, encouraging people to earn through their efforts. However, their independence efforts didn't fully solve the debt issues. This process contributed to laying the economic foundations of modern America, though it was a major disappointment for the investors. The Plymouth Colony venture offers significant lessons on the potential pitfalls of the investment world and illustrates the consequences of failed investments. This story is a reminder to be cautious when investing and that not every plan will succeed. Wall Street's investment world has had its ups and downs throughout history. The 1792 crisis pushed stock trading underground and taught investors to be careful when choosing companies. During this time, well-chosen investments like the company that built the bridge over the Charles River in Massachusetts yielded substantial profits for investors. Similarly, projects like the Lancaster Turnpike brought generous dividends to investors, but this isn't always the case. Investors need to consider the risk that companies can fail. Alexander Hamilton, who laid the foundations of the financial system, understood the importance of banks for economic development. During this period, banks collected money and provided loans for projects like bridges and canals, while public savings financed economic growth. However, banks were also at high risk of failure, and many went bankrupt. Debates about banks led to disagreements between figures like Jefferson and Hamilton. In conclusion, the dynamics of the investment world and the development of the banking system played a critical role in shaping today's economic structure. For investors, choosing the right company and understanding how the economic system works is vital for financial success. In feudal times, being born a serf limited your life and the lives of future generations. However, as the economy and society developed over time, people began to believe in certain laws existing in business and politics. While they understood economic laws like supply and demand, reducing the market's complexity to a single equation was still a challenging task. These ideas helped people acquire wealth and gain economic power. Among America's first millionaires were figures like Robert Morris and Stephen Girard, who became wealthy through shipping and trade. Morris amassed a fortune by supplying the army but eventually went bankrupt. Girard, on the other hand, increased his wealth through banking and investments. These figures, while increasing their economic power during their time, also sparked societal debates about how they would leave their legacies. In the 1800s, there were also debates about stocks and companies. Opinions were divided on whether companies benefited or harmed democracy. During this period, stocks mostly revolved around banks and railroad companies. Although economic fluctuations and crises sometimes challenged investors, the development of capitalism and innovative inventions propelled the American economy and society forward. The invention of farming equipment and chemicals made American agriculture the most productive per acre. Companies like Deere and Caterpillar produced these machines, while other firms developed chemicals to boost productivity. These developments made America a leader in food production, providing a significant advantage over Europe's and Asia's exhausted lands. However, there wasn't a major change in the American diet at that time. Families continued to grow their own food. Railroad companies revitalized trade and the stock market by laying tracks across the country. Firms like Union Pacific and Central Pacific expanded the railroad network with land grants from the government. This attracted new investors to the stock market and boosted America's industrial power. Railroad projects significantly contributed to the settlement of the West and economic growth. By the end of the 19th century, America experienced significant growth in industry and banking. New inventions and machines increased production, while savings accumulated in banks supported industrial investments. During this period, American industry, protected from foreign competition, made substantial contributions to national prosperity. Immigrant workers, employed in low-wage jobs, were an essential part of this growth. During America's industrialization period, particularly in the late 19th and early 20th centuries, snack foods underwent a significant transformation. Initially produced in local bakeries, simple crackers and biscuits diversified and became globally recognized under major brands. Companies like Nabisco made crackers and biscuits more hygienic by packaging them, reaching a wider audience. Iconic products like Oreo were born during this period and continue to enjoy popularity. Simultaneously, Henry J. Heinz, known for Heinz ketchup, made ketchup popular worldwide. Interestingly, Americans initially thought tomatoes were poisonous, but Heinz's innovative approach changed this perception. He developed his own formula, making ketchup an essential part of hamburgers. During this process, mass production and large retail chains radically changed consumer habits. Companies like Montgomery Ward and Sears reached wider audiences with mail-order systems. This not only facilitated the purchase of products at more affordable prices but also fundamentally changed people's shopping habits. The innovations of this period laid the foundations of modern consumer culture. During the era when America grew on its railroads, figures like Cornelius Vanderbilt amassed great fortunes. However, these fortunes often came at the expense of small investors. Economic crises and scandals shook the markets, while robber barons managed to increase their profits. Events like the 1873 crisis led to bank collapses and panicked people trying to withdraw their money. In the late 19th century, trusts and monopolies emerged in a competitive environment. John D. Rockefeller's Standard Oil Trust demonstrated how powerful such structures could be. Monopolies eliminated competition by setting prices. Fortunately, initiatives like the Sherman Antitrust Act and Roosevelt's leadership limited the power of these monopolies. The resurgence of competition offered better prices to consumers and revitalized market dynamics. Examples like the breakup of AT&T highlight the importance of competition. Even today, merger attempts by giants like Microsoft are closely monitored by the government to prevent the formation of trusts. Ensuring competition benefits everyone. In Learn to Earn, Peter Lynch and John Rothchild mention Charles Henry Dow's method for tracking stocks. In 1884, Dow calculated an average by summing the closing prices of 11 significant stocks. This simple idea became a standard in the financial world over the years and is now known as the Dow Jones Index. This index serves as an indicator for understanding the state of the stock market. For example, when you hear the stock market went up 30 points, it's referring to the value calculated by Dow. At the start of Dow's index, railroad companies played a significant role. However, over time, industrial companies took the spotlight. This shift illustrates how America's economic structure has changed over time. For instance, companies like McDonald's and Coca-Cola are now included in the index. This situation demonstrates the dynamic nature of the business world and the challenge of staying at the top. For instance, many industrial giants that once dominated have lost their importance over time. However, some companies like General Electric have withstood the test of time and maintained their top positions. This is an important lesson for investors. It's not only about achieving success but also sustaining it. The Great Depression of 1929 was one of the deepest economic crises in American history and caused many to become cautious about investing in stocks. At that time, many investors bought stocks largely on credit, paying only 10% of the investment amount from their own pockets. When the crisis hit, stock prices plummeted, and many investors couldn't repay their loans. This situation left both individual investors and financial institutions in a difficult position. However, the crisis didn't affect all sectors equally. For instance, food retailers like A&P continued to grow despite economic challenges because people, no matter how tough their circumstances, had to meet their basic food needs. This situation demonstrates that some sectors are more resilient even during crises. On the other hand, the American government learned from past mistakes and adopted measures like injecting more cash into the market and lowering interest rates during economic downturns. These measures aim to mitigate the impact of similar crises in the future and symbolize efforts to maintain economic stability. As Wrigley put it, the more people are distressed, the more they chew gum. This simple observation shows how companies can grow during recessions. For example, A&P, aware of competition, closed small stores and transitioned to supermarkets, adapting to Piggly Wiggly's innovations. Threats always exist in the business world, but the key is accurately identifying these threats. A&P's experience shows that companies must quickly adapt to competitive markets. After World War II, the U.S. economy boomed with the return of soldiers and the rise of suburbs, leading to increased consumption. During this period, Americans remained cautious about stocks. The impact of the 1929 crisis kept them away from stocks, but those who invested long-term reaped significant rewards. The rise of stocks drew people to the stock market. In the 1950s, stocks became widespread, and in the 1990s, a record number of Americans owned stocks. The increase in investors helped spread wealth more broadly. Stock investment became one of the keys to economic growth and individual prosperity over the long term. If we want to enjoy financial comfort later in life, it's crucial to start saving at a young age. Most people can strengthen their financial independence by allocating their income to future investments rather than luxury spending. For instance, a friend named Big Belly spent his earnings on a luxury Camaro and paid installments for years, while Sally Cartwheel chose to buy an old Ford Escort and saved money every month. The most important lessons from this book are: 1. Start investing early. Small savings can grow into substantial wealth over time. 2. Understand the history of markets. Learning from past economic events can guide future investments. 3. Recognize company structures. Knowing the differences between private and public companies helps make informed investment decisions. 4. Diversify investments. Not all sectors are equally affected by economic downturns. Diversification reduces risk. 5. Embrace the power of competition. Competition in markets benefits consumers and revitalizes economic dynamics. 6. Maintain long-term focus. Success isn't just about achieving it, it's about sustaining it over time.